So yesterday, a couple people were asking me about the exam, and I was like, I don't know. So I went and looked at it again. I could, I don't look at it all the time. So it does have some multiple choice questions on it. It has 10 multiple choice questions, all from that content in chapter 2. They're worth 10 points, 1 point each, and then one big journal entry problem worth 90 points. That's how it's structured. It's not like a hit or miss 90 points. It's not like if you miss one on the big journal entry thing, you just lose all the points. It's got points. So if you can do journal entries and answer some multiple choice questions about journal entries, like if this were to happen, which account would be debited or which account would be credited, right? Then you'll get 100 on it. There is a I forget what it's called in there. Exam review. Do that. It's just a practice problem, right? A couple practice problems. You do that and you're like, ooh, I'm not quite comfortable with that, and take a few notes about what you weren't comfortable with, and then do it again, focusing on those things you weren't comfortable with, you'll do fine on the exam. My online class has already taken the exam. It was due Friday for them. And I think out of like 20 people, there were like 15 A's on it, and like one B, and like two C's, and a D or something like that. So it's like very doable, I guess, is what I'm trying to say to you. Um, So you're like, if you're the kind of person right now that's like, I'll be that 1D, you need to stop doing that to yourself, okay? You're smart and you're kind and gentle, and people love you. All right. All right. You don't think so? He's like, no, nobody loves you. Are we going to start preaching the virtues of nihilism in this class? That the world is absolutely meaningless. Nothing you do matters because when you die, you're just going to rot in a hole in the ground. So why bother? No, nihilism's horrible. Doesn't make any sense. There's no logic to it. If you ever want to take moral philosophy class, take my ethics class. We'll talk about it. All right. Nihilism. It's the worst. All right. You think any philosopher who came up with that was totally like not only depressed, but also taking some type of downer drug at the same time? All right. All right. Oh, wait, do you want to hear my philosophy, my logic for belief? All right, here we go. All right. If you believe in like nihilistic or like no God at all, then I guess the nice thing about that is your worst case scenario is when you die, you just like get put into the ground, like you're gone and your body goes in the ground and it like rots away and that's it. So also your best case scenario when you die is that your body gets put in the ground and you're gone and you rot away. So I guess the nice thing about that sort of a mindset is like your worst case and your best case scenario is all the same. Like you know, and I'm getting old enough that I was like, if I were to die and like just disappear, like that was just the end of me, I wouldn't be so bad. Like I had a great life. I have family, grandkids that love me. Like that'd be all right. Whereas like any sort of like faith-based belief usually has like paradise, right, for people who strive or who live righteously or whatever, and like hell or whatever for people who don't. And so that's a little riskier in a sense, right? And for us to believe in that. And so I was talking to my atheist friend and I was like, well, I guess what stinks though is if you're right, then I guess I try to live a good life because of belief, and you don't care because of your belief, and we end up in the same place. So your best case scenario is the same as my worst case scenario if you're right. If I'm right, your worst case scenario or is like hell, right? And my best case scenario is heaven. And so, from a risk perspective, if I believe with faith, then my worst case scenario, if I'm trying to live righteously, is heaven. And my worst case scenario would be if it's all wrong and then I just die like and what he says. But if I'm right, then his best case scenario is living in the hole in the ground dead because that was the end of life. And his worst case scenario is hell. So if he's right, my worst case is the same as his best case. If I'm right, my best case is way better than his worst case. So even if you don't believe, this was trying to mean, yeah, it's always dangerous to logic religion, okay? Because religion sort of defies logic. But to me, I just made a logical case for myself. Didn't work on him. That belief was a better risk. But of course, that's not why I believe, right? I believe because it's what I believe, and I feel like I've had ample proofs of the things I believe, and that the entire world sort of teaches me to continue in that vein. All right. Did you guys want to hear that? Can I get an amen? It wasn't meant to be religious, but it felt a little religious. She's like, yeah, it was absolutely that. That seemed kind of religious. All right. All right. Amen, preacher. All right, I'm not much of a preacher. All right. So yesterday, this is all recorded too for posterity. Someone's gonna be like, Fox is trying to convert us to religion. And I'll be like, oh no, I wasn't. And then like the dean will listen to my recording and be like, nah, you're fired. Like that. Um, all right. Actually, I know our dean, he'd be more like, hey, you shouldn't really be talking about your beliefs in class. And I'd be like, that's my bad. I didn't mean for it to get all churchy. So all right. Anyway, he's really easygoing and easy to get along with. He's very nice, which is nice for having a boss like that. All right. We talked about accruals yesterday. That was when we had earned revenue and had not yet recorded it, right? So at the end of the month, we had to adjust it so that our revenue, we would show the revenue that we had earned, right? Or that we had incurred expenses during the month, but hadn't yet recorded them. So at the end of the month, we had to do an adjustment to show them on our records, right? That's what we learned about yesterday, accruals. So today, there's another type of adjusting entry called a deferral. And with a deferral, we have cash has been received for revenue, but we haven't earned it yet. So this would be like if somebody paid us in advance for work we're about to do. It's very common in certain types of businesses. I used to own a rental storage. And so people would pay me like for a whole year, right? They'd be like, well, how much is it for a month? It'd be $50. Will you give me a discount if I pay for 12 months at a time? Sure, I'll charge you $550. You'll save, you'll pay for 11 months and get the 12th month free or whatever. So they'd write me a check and give it to me. If I recorded that all as revenue the moment they gave it to me, then it's going to make my numbers weird. It's going to violate the matching principle that we talked about yesterday, because I'm going to show all this revenue today, and I will have ongoing expenses of maintaining that property, right, for the next 12 months, but it'll show all my revenue in one month and then all my expenses in other months. And so it doesn't work with the matching principle. So instead, what I do is when they give me the money, I record my cash going up and an asset going up. I'm sorry, a liability going up called unearned revenue, or sometimes it's called unearned rent or something like that. Okay. And that's going to confuse you when you're looking at account names because it will say revenue in its name and you'll be like, oh, it's revenue, but it's not. It's a liability because it's unearned revenue. All that means is it's money I've received that's going to become revenue once I earn it. But right now, I either owe it back to the guy or I owe him the service that I promised to provide to him. Does that make sense? So we have an initial recording with these deferrals. What happens when someone gives us the cash? Cash goes up, so a debit to cash. Unearned revenue goes up, which is a liability. And then our adjustment comes at the end of the month where we say, hey, how much of that unearned revenue have we earned this month? So what's confusing is they'll always do these problems like, you earn it at a rate of $60 per month and or whatever, and you have to like figure out how much it is, right? But if you think about that adjusting entry, all that's happening is we're reducing the liability and increasing the revenue. In other words, we are showing on our records now that we've earned a portion of that revenue. And so the amount we've earned, we can take off of the liability. We don't owe it to the guy anymore. Okay. So that's how an unearned revenue adjustment works. The other ones like it, but it's when cash has been paid for a future expense. So it's like the other side of that transaction. Now, instead of being the person who got paid in advance, I'm paying somebody else in advance. Another common type of business that does a lot of this is insurance. Like it's really common to pay for a full year's insurance all at once, or for 6 months of insurance all at once. Rent sometimes too. People prepay their rent. So my initial recording when I pay the cash would be to debit prepaid expense. Again, it has expense in its name, so it's easy to think, oh, it's an expense account. It's not. It's an asset. It represents money paid in advance, so something's owed to me. Prepaid rent, what's owed to me? Well, the use of the building for the next so many months. That's what's owed to me because I paid for it already. Prepaid insurance, well, what's owed to me is insurance coverage for the next so many months. Okay. So our initial entry will be to increase the asset prepaid expense and increase and decrease the asset cash. Think of it like a gift card, right? If you buy a gift card, what are you doing? Your cash is going down, but you're now getting this card that promises you some future benefit for whatever that gift card's for. Maybe it's Taco Bell because it's Taco Bell Wednesday, right? And so why do we buy gift cards for people instead of giving them cash? What do you think? Would you rather get cash or rather get a gift card for your birthday? Yeah. Well, why do people give gift cards then? I have a theory. I think so. I think it's like saying, I know you love Taco Bell, so I thought about what you love, and I gave you this thing that conveys that I know a little bit about you, right? Even though you're like, if you really knew me, you'd know that as much as I love Taco Bell, I like paying my rent even more because I like having a place to sleep or whatever. But of course, you're like, thank you so much. Next time, give. I don't get the point. That's what my thought is. Um, except that people don't know what to do with cash now. You're like, what do I do with this? And then I want to go like order some. So here's the danger with me of having cash. We did a thing the other day and I had like $60 in cash left over. So I like set it on the top of my dresser. And I was like, I need to deposit that in the bank or I'm just going to fritter it away on nothing. But then I just left it on top of my dresser. And then I'll buy things with like Apple Pay and be like, oh, well, I'll put that money in like to replace that, right? But I never do. So it's like I constantly have this $60 that I can spend on anything over and over and over again until I've spent like $300, but still have the $60 on my dresser that I'm going to put in to replace that money. So that's the danger for me. Cash is dangerous. Cash disappears. All right. Visa gift card, I guess, maybe. I don't know. I think the other thing is with gifts, you want them to have something that's like fun, not their rent, even though they're like, I need rent. But you're like, so if I give them a gift card, they're forced to spend it on something fun. Like, would anybody be sad if they got a Top Golf gift card? Probably some people because they don't like Top Golf, but these guys would like it. I don't think Top Golf is that great, but my son loves it. So I love it because it's a place where we can spend time together. Does that make sense? Yeah. All right. Would you like me to move on with the lesson? I don't know what's happening today, but first I was preaching. Now I'm talking about gift cards. All right. All right. So our adjusting entry, the initial recording when we pay that cash is to debit prepaid expense or increase the asset prepaid expense, credit cash. Cash goes down. Then at the end of the month, when we do our adjusting entry, we're saying, well, how much of that expense have I incurred during this month? So if I prepaid insurance for 3 months, then I would take the total amount I prepaid, divide it by 3, and each month I would debit the insurance expense and credit the prepaid expense. At the end of 3 months, the prepaid expense would be down to 0, and the expense would have been, $100 a month or whatever it was. All this is letting us do, the stuff we learned about yesterday and today, is it's letting us spread out our revenues and expenses so they more closely match how we're earning the money or how we are incurring the expense. Rather than taking it all at once, we're spreading it out over the time we're actually getting benefit from that. Okay. Oop, my clicker's not clicking. If a clicker doesn't click, no, that would be too whimsically philosophical. All right. Is it even a clicker? I don't know. All right. So here's an example. On December 31st, the unadjusted trial balance of net solutions indicates a balance of unearned rent account of $360. I hate when they do this because it doesn't tell you if it's a debit or a credit balance. When they do that to you in these problems, assume it's a normal balance. Okay. So unearned rent is a liability account. Unearned always means liability. Look for that. That's a key word for you. And so if it has a balance of $360, I would assume that means it's a credit balance because that's the normal balance for liability accounts. Okay. This balance represents the receipt of 3 months rent on December 1st for December, January, and February. At the end of December, 1 month's rent has been earned. So this is the sort of information they'll give you, and then you're supposed to make the adjusting entry. So they tell you that $360 is for 3 months. So if I divide 360 by 3, that gives me 120, right? So this must be for $120 a month worth of rent. I don't know what you could rent for $120 a month. Maybe a storage unit, not a house, not an apartment, not even a bedroom in an apartment, right? So our adjusting entry then would be to debit unearned rent or reduce that liability. Now this is $120 that we don't owe back to the customer because they've used it and that we're going to record as rent revenue. So we'll credit rent revenue. So always with these adjustments, what we're doing is reducing the liability and increasing the revenue because we're earning that money month over month. Okay. At the end of February, we'll have done 120 a month on unearned rent for 3 months. And so now the balance of the unearned rent account will be zero. And we'll have recorded revenue of $120 a month in each month, December, January, and February, spreading it out to show that that's really how we earned the rent revenue, not just all at once. All right, so let's do a guided assignment example of it. Let's see. All right. So the balance of the unearned fees account before adjustment at the end of the year is $18,000. Journalize the adjusting entry required in the amount of unearned fees at the end of the, if the amount of unearned fees at the end of the year is $3,600. Again, so the confusing part about these is it will like word it like that. And what they're saying is if we had a balance of $36,000 and the amount left over at the end of the year was 3,600, how much must we have used up, or in this case, earned, right, during the year? So you would just do 36,000 minus 3,600, which should be what? 32,400. So I just took the amount of the previous balance minus the current balance, told us how much we actually earned during the year. Once I know that amount, I can do my adjusting entry, which is to do, what do they call it? Unearned fees, and fees earned. Uh-oh, it didn't like my amount. Where? Oh, where'd I get it? Where'd I get 36,000? Because my brain didn't brain. Is that why everybody was like so quiet? They're like, what the freak is he doing? Do I double it? Call me out earlier, people. Okay. So 18,000 minus 3,600. How much is that? 14,400. Is that right? You guys got to help me out on the math here. Ah, that's better. Have you got to the little stage yet where like green check marks make your heart skip a beat, but red makes you like, I just broke out in a cold sweat. So, like, no. All right. All right. So for prepaid expenses, here we have December 31st, unadjusted trial balance indicates a balance of supplies on account of $2,000. In addition, the prepaid insurance account has a balance of 2,400. Each of these accounts requires an adjusting entry. So it didn't tell us how much. All right. So I guess it didn't have it in there. So the debit balance is 2,400. Again, since it didn't tell us, we had to assume that it was normal balance for this type of account. Prepaid insurance is an asset, so its normal balance will be a debit. Okay. So then they tell us at the end of December, the insurance expense account is in. Oh, it doesn't tell us anywhere. So apparently we were supposed to see somewhere in that problem that the new balance was going to be 2,200. So it's the same process as I did over here, except in this case, it had a balance of 2,400. And at the end of the month, it had a balance of 2,200. So we must have used up 200. Okay. So again, we'll do a couple of examples of this. All right. So the balance in the supplies account before adjustment at the end of the year is 9,000. Journalize the adjusting entry required if the amount of supplies on hand at the end of the year is 1,575. So in real life, the way this works, that does not erase well, is you kind of just keep track of how much supplies you had at the beginning of the period, plus any purchases of supplies you had during the period. And that will give you an unadjusted balance of the amount of supplies you should have. Then at the end of the period, you go in there and count up how much you have, subtract them, and the difference is how much you must have used. Okay. So that's just how they do it. So in this case, if our balance was 9,000 in the supplies account, and then at the end of the year, we count them up and we have 1,575. The question is, well, how much supplies did we use up, right? Because we're going to claim an expense for those. So what's 9,000 minus 1,575? 7,425. Is that right? Anybody? All right. So what happened? Well, we used up supplies. So we're going to debit supplies expense and we're going to credit the asset supplies. In other words, the supplies expense is going up by 7,425 and the supplies asset is going down by 7,425. Yay, green check marks. Green check marks bring joy and happiness and peace like the river. All right. Adjusting entry for prepaid insurance. So our prepaid insurance account has a balance of $3,000 at the beginning of the year. The account was debited $32,500 for premiums on policies purchased during the year. Journalizing the adjusting entry required, or journalize the adjusting entry required under each of the following alternatives. All right. So here we go with our insurance. Okay, why are these not erasing? Should I spit on it? No Hawk Tuah jokes. That time is past. It was only funny for a week. All right. So it has a balance of 3,000. Prepaid insurance as an asset, so we're going to assume it's a debit balance. And then it was debited another 32,500 for insurance premiums they paid during the year, which means our unadjusted balance was 35,500. And now it says the amount of unexpired insurance applicable to future periods is, see, these get confusing because they like to throw in sorts of word problem things. So if the amount of unexpired insurance applicable to future periods is 4,800, how much is our adjusting entry in essence? So what they're saying is if our balance is 4,800, how much must have been used during that period? Even though I think it's confusing the way they worded it. So 35,500 minus 4,800 is 30,700, right? So again, our journal entry, we're going to debit the expense and we're going to credit the prepaid insurance account, $30,700. If we want, we can use a check. And then the second scenario they give us, unless you're British, then it's the second scenario they give us, is the amount of insurance expired during the year is 30,700. If an amount box does not require an actual legal pay. Okay. So I'm not sure what they're going for here. I think they're trying to show us that you could approach this from two different ways, right? One way, the problem tells you how much is left over, and then you calculate how much was used. The second one just tells you the amount of insurance expired during the year is this much. And you'll see problems both ways. And that's part of what's so hard about this chapter is sometimes it will present it where it just tells you the amount that you need to do for the adjusting entry. Like it'll say the amount of insurance expired during the year, meaning the amount that was used up. And other times it'll do it so you have to figure out how much by like telling you this is the amount left over for future periods. So that's part of what makes this chapter so confusing. So it would be the same journal entry though. We would have insurance expense, prepaid insurance, and then the amount that was left or that was used up during the period. So we're always in the journal entry showing how much of that prepaid asset or supplies, which is really a prepaid asset, is used up, and we're going to claim an expense for that by debiting the expense and crediting the asset account. We're halfway there, living on a prayer. All right, me and Bon Jovi. Not his son, who married that girl from Stranger Things. The dad, who made sweet, sweet rock and roll. All right. All right. So there's kind of a special kind of prepaid asset that we think about a little bit differently. And this is when fixed assets, and by fixed assets, I mean things like equipment, buildings, any sort of asset that lasts a really long time. We have to make adjusting entries for these because, again, if I bought a building at the beginning of a year and I'm going to use it for the next 20 years, if I just take the whole $1 million I spent on it as an expense right now, and then no expense for the next 20 years, it doesn't really match up. I'm going to be gaining benefit from that building and using it to generate revenue for the next 20 years. So I want to spread out the cost of those assets over their useful life. The process of spreading out the cost of an asset over its useful life is called depreciation. It's easy, if you've ever heard the term, to think it means something like it's losing value. That's not what's happening. What we're saying is, what's the cost? What's the useful life? And how do I spread that cost out and expense it, or recognize it as an expense spread out across its useful life? So it's a little different, because rather than crediting the asset itself, like we do with the prepaids, we create a special account called accumulated depreciation, where we show the amount that we've claimed as an expense over time. Okay. So here's an example. December 31st, the adjusted trial balance of net solutions indicates they own two fixed assets, land and office equipment. Land does not depreciate. For some reason, we're not allowed to claim the expense of land ever. Thanks, IRS. However, an adjusting entry is recorded for the depreciation on the office equipment for December. Assume the office equipment depreciates $50 during December. So what we do is we just do a journal entry that debits depreciation expense and then credits accumulated depreciation dash office equipment. So you'll have sometimes multiple accumulated depreciation accounts, one for each asset. So this one's called, so you might have one called accumulated depreciation truck A, truck B. Like with my storage, I had accumulated depreciation accounts for building A, building B, building C, building D. And I was depreciating them or recognizing their costs as an expense a little bit each year across their lifetime. Right? Why? So I could match up that expense to the revenue I was generating from those buildings each year. So with these fixed assets, we leave a debit balance on the actual asset the same as our cost. We don't change it. So if the office equipment costs $1,800, its balance will still be $1,800, but then it will have an accumulated depreciation account that goes with it. And a term you'll see in this chapter is that the asset will have a book value, which is its cost minus any accumulated depreciation. Book value means the amount of its cost that has still not yet been recognized as an expense. Okay. So just remember, book value of an asset is always the cost of the asset minus the accumulated depreciation of the asset. Or another way of putting that, the cost minus the amount that we have claimed as an expense already. So we'll go through a couple of practice versions with it and see how we do. I think we're going to do great. I believe in you guys. All right. All right. The estimated amount of depreciation on equipment for the current year is $8,200. Okay, so this one, they're just telling us we depreciate our equipment $8,200 this year. Journalize the adjusting entry to record depreciation. So always depreciation entries look like this. We debit depreciation expense and we credit accumulated depreciation. Again, there'll be a separate accumulated depreciation account for each fixed asset a business has. So all we're doing, remember this deep in your soul, all we're doing when we record a depreciation expense entry is we are claiming a portion of the cost of that asset as an expense. Okay. So 8,200, 8,200. So we're saying $8,200 worth of the cost of that equipment we're now going to claim as an expense. And that's the journal entry to do it. All right, the balance of the equipment account is $3,150,000. That's a lot of equipment. The balance of the accumulated depreciation account is $2,075,000. What is the book value of the equipment? What's the formula for book value? Right. So the balance of the equipment account is always, it stays at the cost. So our cost was $3,150,000. and we've accumulated 2,075,000 depreciation. So our book value then is 3,150,000 minus 2,075,000, which should be 1,075,000. Is that right? 1,075,000. It's just this number minus this number. Does the balance in the accumulated depreciation account mean the equipment's loss of value is $2,075,000? No. Sometimes equipment even appreciates, like you might be able to sell it for more than what you paid for it, right? This has nothing to do with the value of the equipment, everything to do with its cost minus the amount we've recognized as an expense. That's all depreciation is. So we're going to say no, because depreciation is an allocation of the blank of the equipment to periods benefiting from its use, the cost of the equipment. And that's a fancy way of saying we're spreading out or allocating its cost over its useful life. So if we ever have to calculate depreciation, all we do, we'll learn other ways to do it later, but right now, all we do is we take the cost of the asset and divide it by the number of years in its useful life. So if something cost me $1 million and it's going to last for 10 years, how much expense should we take? Well, 1 million divided by 10, or $100,000 each year, which means by the end of its useful life, we'll have fully recognized that cost as an expense. But rather than doing it all at once up front, we've recognized it as $100,000 a year. All we're doing is spreading out the asset's cost over its useful life. That's it. All right. Ooh, there's one other formula you might want to know. So to figure out how much depreciation we do, we take the cost of an asset and we divide it by its useful life. That's what I just told you. And that'll give us the amount to depreciate. Sometimes, though, some assets have like a planned end of life. Like we're going to still sell it back, like a rental car company. They don't like just run those cars to the ground. Instead, they just keep them for like 3 or 4 years until they get like 65,000 miles and then they sell them. So what they do to figure out more accurately how much they should depreciate it is they take the cost minus what they call a salvage value, meaning how much they think the asset will be worth at the end of its useful life. It's an interesting thing, right? Like a rental car company, what they're selling off is still a very useful car to someone who buys it. A car with only 65,000 miles on it might still go for many years, right? So you'll see some problems that have salvage value worked in there. So now if the car costs $30,000 and I think I'll be able to sell it for $10,000 at the end of its useful life, I'll take the 30 minus 10, which will give me 20, and divide that by its useful life. And that'll tell me how much to depreciate each year. Okay, so you'll see some problems like that. All right. I know it's kind of academic right now, and until you get into the problems, it's hard to fully comprehend it. That's normal. All right, last thing for this chapter is what's called an adjusted trial balance. So we already learned how to do an unadjusted trial balance, which was just to go to not our journal, but our ledger and see the balance of each account, and then just put the balance of each account in a list. And we remember, I'm sure we do, that it goes in order of assets, liabilities, stockholders' equity, dividends, revenues, and then expenses. So balance sheet accounts, then income statement accounts. It's always in that same order, okay? All the adjusted trial balance is once we're at the end of the month and we have the unadjusted trial balance, and then we make all these adjusting entries that we've been learning about in this chapter, then we put out a new report, which is an adjusted trial balance, which is just a trial balance with all those new balances after all the adjustments. Remember, those adjustments are going to impact always one income statement account and one balance sheet account. I don't know if you noticed that pattern again when we were doing it today, but that's just a rule that helps you develop your sniff checker. You're like, Something feels off. Oh, that's because there was a cash account in there and there shouldn't be, like that. Just like with the milk, you can know it's bad. I stink at telling if milk's bad. I have to ask my wife. I don't have a super sniffer. Right? She has a super sniffer. And then finally, there's this concept of vertical analysis. We learned about horizontal analysis in the last chapter, where we compared the change in certain items on the income statement or balance sheet, remember, and how much they went up or went down. In vertical analysis, instead, what we do is we just take the highest number on a given statement. So on an income statement, that's revenue. Whoops. Okay, slow down. There it is. And then we just divide all of the other line items by that. So what we're saying is, of the total revenue, how much of it went to wage expense? 32% of it. How much of it went to rent expense? 8% of it. How much of it went to utilities expense, etc. The way we do that is we take each of these numbers and divide it by fees earned. Does that make sense? Because we're finding them as a percentage of fees earned. On a balance sheet, I thought I had it on there, the highest number will be total assets, right? Because assets equal liabilities plus equity. So assets will be the highest number. And again, it lets us say out of all of our assets, what percentage is land, what percentage is equipment, and then how much, what percentage is liabilities and what percentage is equity, because those two together should add up to the same as the assets, right? So that's all vertical analysis is comparing an item on your statement to, on the income statement, fees earned, and on the balance sheet, total assets, and finding it as a percentage. That's all you do for that. There'll probably be like one question on your homework about that. Let's look at this last question. On the guided assignment. All right. For each of the following errors considered individually, indicate whether the error would cause the adjusted trial balance totals to be unequal. If the error would cause the adjusted trial balance totals to be unequal, indicate whether the debit or credit total is higher and by how much. All right, so this is one of those deeper thinking questions that when you come to them on your homework, you're like, I don't freaking know, man. Why are you bothering me with stupid questions, Sengage? Like that. Maybe you don't feel that way, but I do sometimes. So we have to consider, all right, on the credit side of that trial balance, we're going to have assets, dividends, and expenses, right? Those are the ones that will contribute to the debit side. And on the credit side, we're going to have liabilities, and revenues, and that's it. Those are the things that contribute to the credit side. So let's take a look at this. The adjustment for accrued wages is $5,200, and it was journalized as a debit to wage expense for $5,200 and a credit to accounts payable for $5,200. All right, so for each of the following errors. So what should be our adjustment for accrued wages, right? Accrued wages means our people worked, but we haven't yet paid them. So we should make an adjustment at the end of the period that goes something like wage expense, 5,200, and wages payable, 5,200. That's what our adjustment should be. It shows we've incurred the expense during the month, but we haven't yet paid it. We're going to pay it next month on the next payday. Okay. So, but here it says the adjustment they did was a debit for wage expense, which is what we did. And then they credited accounts payable instead of wages payable. So here's my question. Would it throw this out? So we had a debit to an expense account, which we would expect. We had a credit to a liability account. It's just the wrong liability account, right? That's the error they made. Instead of putting it to wages payable, they put it to accounts payable. So would that throw off our trial balance? The answer is no. The correct entry should have had a debit to an expense and a credit to a liability, and the error also had that. But what stinks about that error is it's harder to notice because you're like, everything still balances, okay? So the totals are equal. Enter the difference between the debit and credit totals. If the totals are equal, enter a 0. Make sure we understand what they're asking of us. Good. And then the last one, the entry of 1125 for supplies used during the period was journalized as a debit to supplies expense of 1125 and a credit to supplies of 1152. What should we do for supplies expense? We should debit supplies expense and then credit supplies. And we used 1125. So that's what the correct entry should be. Here it says that we debited, let's see, supplies expense 1125. So we did that correctly. And we credited supplies 1152. Just so you know, that's called a transposition error where you switch two numbers around, you transpose them, okay? So in this case, our supplies credit entry is higher than it's supposed to be. Does that make sense? And which means it's going to make the entire side of that trial balance higher. By how much? Well, 1152 minus 1125 should be $27. So we're going to say the credit side, this reducing our asset supplies, we did it by too much. So the credit side is going to be higher and the difference is going to be $27. These are the kind of questions that I think are tougher questions. They're sort of like second order thinking. The first order is just doing the process. And then this is like, well, why is the process wrong or off, right? So they're a little tougher. All right, so that's all we have time for today. I apologize if I offended anybody with my logical treatise on belief. I apologize, and if you want to come tell me what a horrible person I am, that is totally fine with me, because I know I'm a horrible person sometimes. Anyway, I hope you have a terrific day. I don't know, make good choices. We did the two data assignments. Are we good? Still want to